somewhere inside a smelting plant right now. A machine is running at a loss, processing metal that costs more to refine than anyone is willing to pay for it. No headline is covering this, no trading app shows you this number, but a handful of insiders already know that the pipeline turning raw ore into pure silver is quietly breaking down. And if it fails, the shortage that follows won't be temporary. So what exactly is happening behind those factory walls? Welcome back, and thank you for spending a few minutes of your day with us here on Currency Matrix. Whatever's happening in your part of the world right now, whether you're sipping your morning coffee or winding down after a long day, we're glad you're here with us. If you find value in what we share, we'd be honored if you considered subscribing to the channel. It helps us keep bringing you clear, honest analysis on the stories that matter to your financial future. And we'd love to know, where are you watching from today? Drop it in the comments. We truly enjoy hearing from you. Silver has always carried an image of purity. People picture a shiny bar pulled straight from the earth, ready to be shaped into coins and jewelry. But that picture is misleading. Most silver never comes from a mine built to find silver at all. According to industry data, only about 1/4 of the world's silver supply comes from mines that target silver as their main product. The rest, nearly 3/4, is a byproduct. It is found almost by accident, mixed into the ore of mines that are really searching for copper, lead, and zinc. Workers digging for these base metals simply happen to find small traces of silver along the way. This detail matters more than most people realize. When the price of a normal product rises, companies usually respond by making more of it. But silver does not work that way. A zinc mine cannot decide to dig for more silver just because silver prices go up. It digs based on the economics of zinc. If the world needs less zinc, that mine slows down, and silver production slows down with it, no matter how high silver prices climb. This is one reason the world has now spent 6 years in a row producing less silver than it actually uses. Analysts who study the market closely describe this gap as a structural deficit, meaning it is not a short-term problem. It is built into the way silver is produced. But finding the ore is only the first step. Once miners pull raw rock out of the ground, it is far from finished. That rock is a rough mixture, not pure metal. It must be sent to a smelter, a large industrial facility that separates and purifies the silver hidden inside. This is where the current trouble begins. To get their ore processed, mining companies pay smelters a fee known as a treatment charge. In a healthy market, smelters have the upper hand. Miners compete for limited processing space, and smelters can charge a solid fee for their work, often more than $100 per ton. But over the last 2 years, something changed. A wave of new smelting facilities opened, especially across China. Suddenly, there were far more processing plants than there was ore to fill them. Smelters that once had the advantage found themselves competing hard just to secure enough raw material to stay running. To attract business, they began cutting their fees again and again. The drop has been dramatic. In 2024, the standard fee smelters charged per ton of copper ore was a healthy $165. By 2025, that number had been cut in half. And by 2026, it fell all the way to zero. In some cases, the spot fees in the zinc and lead markets, the very markets where most byproduct silver is hidden, turned negative, dropping to a loss of $70 to $120 per ton. In simple terms, smelters are now paying miners to bring them ore instead of being paid for their own work. A business that has to pay its own customers just to keep operating cannot survive that way forever. This shift did not happen overnight, and it did not happen by accident. It followed years of rapid expansion in processing capacity, built faster than the supply of raw ore could keep up. Now, that imbalance is putting real pressure on an industry that quietly stands between raw rock in the ground and the silver bars, coins, and industrial parts people rely on every day. What began as a quiet financial detail inside the mining industry has now caught the attention of global energy and minerals experts. And the questions being raised go far beyond a single number on a company report. To understand how serious this situation has become, it helps to picture the smelting industry as a chain of factories that most people never think about. These plants don't make headlines, they don't have flashy branding, but they sit at the exact point where raw rock becomes usable metal. And right now, that point is under real strain. Think of a treatment charge as rent. A mining company digs up rock filled with copper, lead, or zinc, and buried inside that rock are small traces of silver. To turn that rock into something sellable, the miner has to send it to a smelter and pay a fee for the service, much like paying rent to use someone else's equipment and expertise. For decades, that rent was steady and predictable. Not anymore. As new smelters opened across the world, especially in China, the balance of power flipped. There were suddenly too many factories competing for too little rock. Smelters, desperate to keep their furnaces running, began slashing the rent they charged. Eventually, in some markets, the rent turned negative. Instead of the miner paying the smelter began effectively paying the miner just to receive the ore. This is not a small technical detail. It strikes at the heart of how these facilities stay in business. Processing plants are expensive to build and expensive to run. Multi-billion-dollar complexes depend on steady income just to cover electricity, labor, and maintenance. When their main source of revenue disappears, and even turns into a loss, they have to find another way to survive. That other way has been silver itself. Since so much silver arrives as a hidden byproduct inside copper, lead, and zinc ore, smelters have leaned heavily on selling that recovered silver to make up for their losses on processing fees. In other words, the profit smelters used to earn from doing their job is now expected to come from the leftover precious metal they find along the way. But this backup plan has a serious weakness. Silver prices, after reaching extraordinary highs earlier this year, have pulled back sharply. That means the safety net smelters we're relying on is shrinking at the exact moment they need it most. This is where major institutions have started paying close attention. The International Energy Agency, an organization that tracks global energy and mineral supply chains, issued a warning about exactly this problem. According to their report, smelters located outside of China are not simple factories that can easily be replaced. They are described as strategic processing hubs, facilities that unlock critical materials the modern world depends on, silver being one of the most important. The agency's warning was direct. If negative processing fees and shrinking metal profits continue, smelters outside of China could face serious economic pressure. That pressure, if it continues long enough, could lead to plant closures and even bankruptcies. This warning lines up with another significant development. Silver has recently been added to official lists of critical minerals by government agencies studying supply security. That listing does not happen without reason. It reflects growing concern that the world's ability to process this metal reliably is no longer something to take for granted. What makes this moment different from past market swings is the location of the problem. This isn't happening on a trading screen where prices bounce up and down every day. It's happening deep inside industrial facilities, in a part of the supply chain most investors rarely think about. And according to the world's own energy watchdog, the warning signs are no longer theoretical. They are already showing up in the numbers. Every supply chain has a weak link, and right now, many analysts believe they have found it inside the smelting industry. If Western processing plants continue losing money the way they have been, the consequences would not stay contained to a single factory or a single company. They would ripple outward into the global economy. The most immediate concern is what happens to Western smelters that simply cannot survive on negative fees. Running one of these facilities is expensive. Keeping the furnaces lit, paying skilled workers, and maintaining massive industrial equipment requires steady income. When that income turns into a loss, a business has only a few options: absorb the pain for a while, cut costs, or eventually shut down. If enough facilities choose the third option, the world could see processing capacity outside of China shrink at the same time global demand for refined metals continues rising. That combination would tighten the pipeline even further, making it harder to turn raw ore into usable silver, copper, and other metals. This is where the story becomes bigger than any one factory. Data shows that China already controls a very large share of the world's smelting capacity, and its facilities have been running at a much higher rate than plants elsewhere. If Western smelters slow down or close their doors, more of the world's raw material would need to travel to Chinese facilities simply to be processed into finished metal. Some analysts view this as a natural result of competition and economics, nothing unusual in a global market where costs and capacity constantly shift. Businesses expand where conditions are favorable, and they pull back where they are not. From this perspective, the smelting industry is simply going through a correction after a period of rapid overbuilding. Others see it differently. They view control over processing capacity as a strategic issue, not just an economic one. Silver and other critical minerals are used far beyond jewelry and coins. They power solar panels, electric vehicles, batteries, and advanced electronics. If most of the world's processing power becomes concentrated in one region, some experts argue that gives that region significant influence over how quickly and cheaply the rest of the world can access these materials. Government agencies have already begun responding to this concern. Silver's addition to official critical minerals lists reflects a growing recognition that supply security matters just as much as price. When a material is labeled critical, it usually signals that officials are watching the entire chain, not just the mining stage, but the processing stage as well. For everyday people, these consequences may feel distant at first. Few people think about smelters when they buy a phone, an electric car, or a piece of jewelry, but industries that rely on silver, especially solar energy and electronics manufacturing, depend on a steady and reliable source of refined metal. If that source becomes less predictable, costs could shift, and supply chains could face new pressure points that eventually affect consumers as well. There's also an economic angle worth understanding. Silver behaves differently from many other commodities because so much of it arrives as a byproduct. Since production is not driven directly by silver prices, a supply squeeze caused by processing problems cannot be solved quickly just by digging more ore. The bottleneck exists at the refining stage, not the mining stage, and that makes it a slower, more structural issue rather than something that resolves itself in a matter of weeks. Not every analyst agrees on how severe this will become, and predictions about mineral markets carry real uncertainty. Some believe the industry will adjust naturally as weaker smelters close and stronger ones absorb the difference. Others believe the pressure could build into a genuine supply crunch if conditions do not improve. What is clear is that this issue sits at an important crossroads between economics, industry, and global strategy, and it is being watched closely by people who track critical minerals for a living. So where does this leave the silver market, and what should people watch for in the months ahead? Analysts who track this industry closely will likely be watching a few key signals. The first is whether treatment charges begin to recover or stay stuck in negative territory. If smelters keep losing money on every ton they process, more announcements about slowdowns or closures could follow. The second signal is silver's own price. Since many smelters now depend on selling recovered silver just to stay afloat, any further drop in price could add even more pressure to an already strained system. Industry groups such as the Silver Institute and Metals Focus are expected to continue publishing updated figures on the size of the global supply deficit. Watching whether that gap widens or narrows will give a clearer picture of how tight the market really is becoming. At the same time, organizations like the International Energy Agency may issue further updates on smelter conditions outside of China, since they have already flagged this as a developing concern. There are also broader questions worth thinking about. Some viewers may wonder whether governments will step in to support struggling smelters, given that silver has now been placed on critical minerals lists in some countries. Others may wonder whether demand from industries like solar energy and electric vehicles will keep rising fast enough to outweigh any supply disruptions. These are not questions with easy answers, and even experienced analysts hold different views on how this will play out. That's exactly why this story deserves ongoing attention rather than a single headline. It touches mining companies, industrial manufacturers, government agencies, and everyday consumers, all connected through a supply chain most people rarely think about until something goes wrong. For anyone who wants to follow this story responsibly, a few simple habits can help. Pay attention to reports from established industry groups rather than short-term price predictions alone. Look for updates on treatment charges and smelter capacity, since these numbers often move before silver prices do. And remember that commodity markets, especially silver, tend to be volatile, so patience and careful research matter more than reacting to any single piece of news. Here are a few questions worth sitting with. If processing costs remain this difficult, how might that change the way industries plan for the materials they depend on? If more of the world's refining capacity becomes concentrated in one region, what could that mean for global trade in the years ahead? And how might everyday products, from solar panels to electronics, be affected if this bottleneck continues? Viewers are encouraged to share their own thoughts on these questions in the comments below. Some may see this as a temporary market adjustment. Others may see it as the early stage of a much bigger shift in how critical minerals move around the world. Both perspectives are worth discussing, and hearing different viewpoints often leads to a better understanding of a complex issue like this one. What is certain is that this story is far from finished. The smelting industry rarely makes headlines, but as this report has shown, it plays a critical role in determining how much refined silver actually reaches the market. Whether the pressure inside these processing plants eases or continues to build will shape supply conditions for years to come. Thank you for spending this time with Currency Matrix. Stories like this one rarely get the attention they deserve, yet they often explain far more about where a market is heading than any single day's price movement. Understanding what happens deep inside the supply chain gives a clearer, more complete picture than watching numbers on a screen alone. If this report added value, consider subscribing so future updates on this story and others like it reach your feed as they develop. And as always, thank you for trusting Currency Matrix to help make sense of the stories shaping the world of money and markets.